Right now, at this exact moment on Saturday, April 18th, 2026, 3 separate crisis timers are running simultaneously, and not a single major financial news outlet is connecting all 3 dots. The markets are locked, the COMEX is dark, the Federal Reserve is legally silenced, and Tehran has not said a single word to confirm or deny the peace agreement that Donald Trump announced to the world on Thursday. We are sitting inside a 42-hour window where the paper price of silver is frozen at Friday's official close of $79.60, but the actual physical market is trading at $81 a dollar, $55 to $82 in the shadow sessions, running through Singapore, Dubai, and Zurich. 3 massive forces are converging on Monday's open simultaneously, and the combination of these 3 forces creates a scenario that the silver market has never experienced before in its entire modern history. The Iran silence is not accidental. The Fed blackout is not coincidental. And the COMEX crisis is not temporary. These 3 things are happening at the same time for the first time ever, and Monday morning is the detonation point. Let's start with the Iran silence because this is the wild card that makes everything else unpredictable. On Thursday, April 17th, Donald Trump stood before cameras and announced that the Islamic Republic of Iran had agreed to a comprehensive 15-point peace framework. According to Trump, Tehran agreed to permanently abandon its nuclear weapons program, reopen the Strait of Hormuz to all international shipping, and provide discounted oil to global markets as a gesture of goodwill. The financial markets heard those words and immediately priced in a full resolution of the crisis. Oil crashed 10% in a single session. The U.S. dollar index collapsed to pre-war levels. Rate cut expectations for the Federal Reserve flooded back into the market. Stock futures surged, and silver, which was grinding sideways near $77, jumped to touch $82 in the shadow market. Everything moved as if the war was over. But here is the reality that every single investor needs to understand before the markets open on Monday. Iran's supreme leader has not spoken. The Iranian Foreign Ministry has not issued a press release. The Iranian Revolutionary Guard Corps, which controls the actual military assets blocking the strait, has not issued any stand-down orders. As of this Saturday morning, the Strait of Hormuz is still physically blocked by naval forces. There is no verified peace deal. The entire market reaction was based on one man's press conference. This creates a binary event of historic proportions for silver. If Iran comes out over this weekend and officially verifies the peace agreement, the dollar will drop further, oil will stay suppressed, and rate cut expectations will solidify, which will push silver through $85 and potentially toward $90 by Tuesday. But if Iran rejects the framework, calls Trump's announcement a fabrication, or simply continues its silence into Monday morning, the market will face a brutal recalibration. The war premium that was stripped out of the dollar on Friday will come flooding back. Oil will bounce sharply from its 10% drop. And silver, caught in the middle of this whipsaw, will face a volatile open that could move $5 in either direction within the first 30 minutes of trading. The 42-hour market closure is not giving investors time to rest. It is a pressure cooker building toward an explosion. Now, let's move to the second crisis timer, the Federal Reserve blackout. Most investors know that the Fed has scheduled meetings and communication calendars, but very few understand the mechanics of what happens when the blackout begins. The FOMC blackout period started yesterday, Friday, April 18th, 2026, and it will remain in effect until after the April 28th and 29th FOMC meeting concludes. For the next 12 days, every single Federal Reserve governor, every regional Fed president, and every senior staff economist is legally prohibited from making public statements about monetary policy. Jerome Powell cannot speak. John Williams cannot do interviews. No one at the Fed can issue a correction, a clarification, or a warning. Whatever narrative exists in the market right now is the narrative that will dominate for 12 full days without any central bank intervention. And the current market narrative is extremely bullish for silver. Following Friday's oil crash and dollar collapse, the CME FedWatch tool is now showing a greater than 60% probability of a rate cut at the June FOMC meeting. Year-end rate expectations have dropped below 3.5% for the first time since early March. The bond market is pricing in 2 full rate cuts before December. If any Fed governor could speak right now, they would almost certainly push back against this aggressive easing narrative because inflation is still running above target and the labor market remains tight. But they cannot speak. The blackout has sealed their mouths, and the market is free to price in whatever level of rate cuts it wants with zero pushback from the institution that actually controls rates. For silver, this is a 12-day green light. A weaker dollar driven by rate cut expectations is the single most powerful bullish catalyst in the silver market, and that catalyst has just been given a 12-day uninterrupted runway. The timing gets even more interesting when you add the Kevin Warsh dimension. Warsh is Trump's nominee to replace Jerome Powell as Fed chair, and his Senate confirmation hearing is scheduled for Monday, April 21st. This means that on Monday morning, While the COMEX is opening and the Iran situation is being assessed, the most important monetary policy hearing of 2026 is happening simultaneously in Washington. Markets had initially feared Warsh because he built his reputation as an inflation hawk who favored higher rates and tighter money. When his nomination was announced in January, silver crashed 39% in a single day because traders assumed he would keep rates elevated indefinitely. But the data has shifted dramatically since January. Fed Governor Stephen Mirren stated publicly this week that he expects inflation to return to target within a year and views the current energy-driven price surge as temporary. If Warsh echoes this sentiment during Monday's hearing, the market will immediately reprice to reflect a dovish Fed under new leadership. That repricing will hit silver like a freight train because silver's biggest enemy in 2026 has been the fear of persistent high rates. And if that fear is removed, there's nothing standing between silver and $95. Now let's connect the third crisis timer, the COMEX vault emergency. While Iran is silent and the Fed is silent, the COMEX vaults are screaming. As of Friday's close, COMEX registered silver inventory sits at 76.4 million ounces. This is the only silver that is legally available to settle physical delivery claims against futures contracts. The total open interest on the exchange is 571 million ounces, which means the coverage ratio is 13.4%. In 2019, before the bull market began, the coverage ratio was consistently above 35%. During the 2020 COVID panic, when premiums exploded and the U.S. Mint ran out of silver eagles, the ratio was around 28%. Today, it is 13.4%, and May delivery season just went active this week. The mechanics of what happens next are straightforward and terrifying. Every month, a certain percentage of futures contract holders decide to stand for delivery, rather than rolling their contracts forward or settling in cash. In normal market conditions, that percentage is around 5% to 8%. At 8% delivery demand against 571 million ounces of open interest, you get approximately 45 million ounces of delivery requests. The COMEX only has 76 million ounces registered. That leaves a buffer of only 31 million ounces, which sounds manageable until you factor in that industrial users and long-term contract holders have already locked up a significant portion of registered inventory through forward purchase agreements. The actual free float of deliverable silver on the COMEX could be as low as 30 to 40 million ounces, which means even a slightly above average delivery month could trigger a shortage. In January 2026, during the peak of the Iran war panic, delivery demand spiked to nearly 40% of open interest. If that level of demand returns in May, the numbers become catastrophic. 40% of 571 million ounces is 228 million ounces of delivery requests against 76 million ounces of available metal. The exchange would have to suspend physical delivery, declare force majeure, and settle contracts in cash at the current paper price. That event would instantly expose the fraud at the heart of the paper silver market and trigger a global run on every paper silver instrument, from ETFs to unallocated bank accounts to certificates. The price of physical silver would immediately detach from the paper price and reset at whatever level clears the physical market. Based on current dealer premiums and the Shanghai Gold Exchange premium, that clearing price is north of $100 per ounce. The drain on registered inventory is accelerating in a way that is not getting enough attention. In the first 2 weeks of April alone, registered silver fell by approximately 2.8 million ounces. That is a monthly run rate of nearly 6 million ounces, which is 50% faster than the drain rate in the first quarter of 2026. The acceleration is being driven by three forces simultaneously. First, China's record import pace of 206 tons in January and February is pulling metal out of Western vaults through the arbitrage premium on the Shanghai Gold Exchange, which is currently $2 to $4 above the COMEX spot price. Second, industrial users are pre-buying silver inventory ahead of what they expect to be a summer shortage, with solar manufacturers and EV battery producers accelerating their procurement schedules. Third, institutional investors who survived the January crash from $121 to $71 are converting their paper positions into physical metal, taking delivery at the COMEX to avoid the counterparty risk of holding paper in a system with 13.4% coverage. There's also a critical connection between the oil market crash on Friday and silver's industrial demand that most analysts are completely missing. When oil prices fall 10% in a single day, as they did on Friday, the cost of manufacturing solar panels drops almost immediately. Silicon refining, glass production, and transportation costs all decline in proportion to energy prices. This makes solar energy more economically competitive against fossil fuels, which accelerates the pace of solar installation globally. Since photovoltaic solar cells are the largest single category of industrial silver consumption, consuming approximately 140 million ounces annually, A sustained drop in oil prices would actually increase silver demand, not decrease it. The mainstream narrative says lower oil equals lower inflation equals lower silver prices. The reality is lower oil equals more solar equals more silver consumption. Silver wins on the commodity side even as it wins on the monetary side. The deficit math is relentless. The World Silver Survey 2026, released this week, confirmed that 2026 is tracking to be the 6th consecutive year of a structural supply deficit. Total above-ground stocks have been depleted by 762 million ounces since 2021. That is equivalent to an entire year of global mine production simply erased from the available supply pool. Mine production is currently running at approximately 822 million ounces per year globally, but consumption is outpacing that by 67 million ounces annually. You cannot close a 762 million ounce deficit hole by hoping for a peace deal in the Middle East. You cannot fix a 6-year structural shortage with a tweet. The only things that can solve this deficit are either a massive new silver discovery and mine build-out, which takes 10 to 15 years, or a price high enough to destroy demand. Given that silver's industrial applications are in sectors with no viable substitutes — solar, batteries, electronics, medicine — the demand destruction scenario requires a price so high that it essentially confirms everything the silver bulls have been saying for years. As the 42-hour clock ticks toward Monday's open, 3 questions will determine where silver goes next. Will Iran speak? Will Warsh be dovish? Will May delivery demand exceed what the COMEX can handle? The answer to any one of these questions could move silver $5 in either direction. Now, the answer to all 3 simultaneously could create the most violent gap open in silver's modern history. The shadow market is already at $82. The physical premium is already baked in at $7 to $12 above paper prices. The deficit is running at 67 million ounces per year. The vaults are at 13.4% coverage. And the Fed is legally silent for 12 days with no ability to talk the market down. This is the trifecta that nobody on financial television is connecting because they only cover one story at a time. But the silver market does not care about one story at a time. It is responding to all 3 simultaneously, and the weight of those 3 forces is pushing in one direction. The 42 hours between now and Monday's open are the most consequential hours the silver market has faced all year. When the COMEX opens, the world will find out if 13.4% coverage is a number that can be defended, or if May delivery season is the event that finally breaks the paper market's grip on physical silver. This is the hidden ag, and the trifecta is ticking. Stay sharp, stay physical, and do not look away from Monday's open. The silver market is about to show the world what happens when 3 crises collide at exactly the same moment.